Good afternoon, everyone. Thank you for joining us on the second day of Argus Online Energy Forum. We're doing especially for our IOC team. My name is Parimal. I'm the Global Account Manager for Indian Oil Group of Companies. Uh, Yesterday, we touched base on crude oil markets, and Francis and Alejandro, they touched base on how the crude markets would look like in the coming few months and the long term as well. So, building on that today, we would be presenting on two very interesting topics. That will be refined products. How do we see light, heavy, and middle distillates in the coming, in the short term and long term? That will be presented by Francis. Another presentation would be by Vlasios. We are going to present on Argus Possibility Curves, which is a very innovative data science approach of using AI and machine learning to forecast crude prices as well as refined products in the near future. So please switch off your camera and mic at all times. We will be recording the session and uploading it on Indian Oil Service Portal. I hope you would be able to download slides as well. And tomorrow we'll be uploading it by today. So without any further ado, I would like to ask Francis to come on board and we can start the presentation.
Very good. Thank you very much, Parimal. Greetings, everybody. I hope you're all well and bearing up at this very difficult time. Our thoughts are with you, clearly. It's a very difficult situation. I've put my slides on the screen. If someone friendly could just confirm that they can see them, that would reassure me.
Yeah, Francis, we can see it.
Great, thank you. Presenting virtually is a little bit of a nerve-wracking at times. I sometimes get to the point where I wonder if anyone's left at all out there listening, or have I muted myself, or what on earth is going on. But I'm sure if anything technically goes wrong, people will, I'm sure, shout. But I'm going to kick off this meeting with a review of our thoughts around the products markets, the refining space generally. Do a little bit of a review about what's happened. I'm sure we don't really need to be reminded, but I think there are some interesting aspects of it which maybe aren't immediately clear to some people. And then obviously we'll be much more interested in how we see the future, and it's going to be largely short term, but I do want to just touch on the very real issue of the energy transition, because that is now very firmly in focus and on the horizon. And as a refiner and energy company generally, you need to obviously be considering it right now. It may not affect you for another 5, 10, maybe longer amount of years, but it is very real, and it's a sizable change in the market environment. But let's just recap about 2020. Obviously, cracks could not possibly withstand. No industry can withstand the loss of 25% of its market in the space of a couple of weeks. There would be no industry in the world that could be resilient to that. And as demand collapsed, and it did collapse in April, it was 25 million barrels a day lower than the year before. Not unnaturally, prices slid along with the physical demand for the product. And here we can see across all the three main refining hubs, and also just an illustrative average across those three, arithmetic average, no weighting involved. For the four main product categories, the cracks basis regional benchmarks. Gasoline was less affected than jet. Jet was clearly the big loser because of the complete collapse in air traffic for a period of time. Diesel held up pretty well for a period of time. when prices began to fall, outright prices, that is, because they're aligned obviously with crude price, when the flat price of diesel and gas oils generally began to fall, actually that's an opportunity for consumers to restock, and we saw a considerable amount of tertiary restocking, anything from a residential heating oil consumer in Europe to an agricultural or industrial consumer anywhere in the world. It's an opportunity to refill tank with cheap product, and that kind of helped diesel avoid the worst of the impact of the pandemic, at least in the early weeks. But in the end, once that restocking had taken place, then the full consequences of the collapse in demand hit diesel cracks, and we've seen extraordinarily low middle distillate prices and cracks versus crude. The worst really that we've ever seen on a sustained basis. I think one of the interesting aspects which people actually are always a little surprised when I point out to them was that all the headlines, of course, were about lockdowns and the loss of traffic on the roads and the collapse in fuel demand. Actually, 2020 was better than 2019, at least for a period of time. So in 2019, we actually saw cracks virtually at parity to crude for a short period of time early in the year. Yes, they recovered in the summer months when the driving seasons kicked in. I think certainly we would be correct in saying that gasoline last year on average was worse than in 2019, but it's always worth bearing in mind that very, very low gasoline cracks is not unknown, and we saw a very real incidence of that the year before in early 19. And then at the heavy end of the barrel, quite the opposite. High sulfur fuel oil prices collapsed at the very start of the year as the bunker fuel specification changed. The market for high sulfur fuel oil literally dried up overnight with that specification change. But actually since then, prices have been extraordinarily strong, and we'll discuss the reasons for that in a short while. So given the appalling cracks that we saw last year, it's inevitable that refining has really had the worst possible year you could imagine. We're never really particularly encouraged by margins for cracking, for the FCC margins. These are all variable cost margins, they're not full cost. FCC margins tend to break even. They in Singapore versus Dubai, they're usually positive, not last year, as we can show in the middle chart here. But across all the refining regions, the FCC has really struggled. But that is not necessarily unusual. What is unusual is that the complex refineries configuration has similarly struggled to make any money at all. I can't remember a year where coking, hydrocracking and coking has been, if not only mildly positive, possibly even outright negative, as in the case of our indicator coker margin for Singapore versus Dubai. And this is a catastrophe for the industry generally. Basically, refining made no money whatsoever. It lost money hand over fist last year in the face of this catastrophic drop in demand. Not everyone lost money. The Chinese actually had a very good year. Chinese refiners, they're pretty sophisticated, a lot of them. They run modern, sophisticated, complex operations. But Chinese refiners generally were able to make extremely good margins for a large period of last year, simply because the inland prices at which they market are controlled. So we measure here the Singapore FOB gasoline and diesel price on the right hand side against a weighted, an average Chinese gasoline and diesel retail price net of tax, and you can see that the spread is significant, to say the least. And this really did underpin a very good year for some of the refining companies. I spoke with one of the very largest refiners, and they said quite openly that actually 2020 was the best year they've ever had. So it's not a level playing field by any chance. By any means, and in the case of China, China is actually a very significant marginal exporter to global markets. The bulk of the product remains in the east, in the Southeast Asian markets, Oceania, places like that. But it is increasingly, we see increasing volumes of Chinese product coming into the Atlantic basin. And it is purely a function that they have over-invested in capacity. It's unkind to say it was a mistake, because when the refinery projects were first planned, everyone was incredibly bullish about the prospects for Chinese demand growth. Those prospects have steadily weakened, have actually vanished in the last year or so. I don't think there has been any increase in real inland Chinese domestic fuel consumption for well over a year now. The data is extremely patchy, unreliable, but looking at the results of the main retailers, there has been really no increase in domestic fuel sales for well over a year now. And so it leaves a lot of product coming to market, and when they have such a healthy margin on inland sales, one wonders exactly how sensitive they are to the export margin in order to keep product flowing and utilization at high levels. So where do we go from here? Clearly we're in the beginning of a recovery mode. Unfortunately, it is a harsh fact of life that the recovery from into a post-COVID world is very much two-paced. It's going to be very much quicker I'm afraid to say, in the UK than it will be in India. If we look at the top left chart, we've extrapolated recent trends to try and understand where we might, or how long it might be before certain countries and regions get to herd immunity. And herd immunity is defined as 70% of the population having had the 2 vaccination jabs that are required theoretically for full immunity. And the US is furthest down the road, slightly late starter, but very, very impressive rollout of vaccines. They're not exporting to anyone, they're keeping it all for themselves, and it's working very well. So middle of this year, they should probably achieve herd immunity. The UK will be the same. I think the latest number in the UK is August. The EU, which is a little later, is probably at the end of this year. And unfortunately, in the case of yourselves, India, and I do absolutely emphasize this is a straightforward statistical extrapolation of what has been happening in recent months. Well, if that does not change, then it will be quite a period of time before you could assume that you've achieved herd immunity, January 23. And that's a rather depressing and frightening aspect. But of course, I think more countries and regions are in the categories such as yourselves than in the US, if you like. So the pace of herd immunity, it will come, but it's going to be hard fought and relatively slow in being achieved. And as long as that happens, then we're always going to be liable to lockdowns and further hiccups in the demand recovery. And equally, if we look on the right-hand side at the top, then the fiscal response to the COVID crisis is equally uneven. If we look at the advanced economies, perhaps it's only natural that this is how it turns out, but the amount of fiscal stimulus and infrastructure spending which injected by governments to try and kickstart the economies, shown here as a percent of GDP. Well, in the advanced economies, it's been 25% of GDP. It's enormous. In the emerging markets, it's much lower at 6%, and in the low-income economies across the world, it's minimal. There's very little fiscal stimulus in hand, and this means that whilst I think the markets generally are very upbeat about prospects in the US, the general expectation is for a relatively strong and rapid recovery in the US economy. The same cannot be said for very much for large parts of the rest of the world, where I think economic scarring and growth will be extensive, and growth will be relatively slow. So this will be another drag on the demand recovery. And obviously, as long as COVID is still a large presence across the globe, then the return to a normal level of air traffic is going to be much delayed. It's still on a global level about 75% below the equivalent period in 2019. And we don't expect really the air traffic situation to get back to pre-COVID normality until probably around 2023. So that's going to depress jet fuel demand, clearly. And if we just look at some of the key economies where we traditionally expect demand growth to be relatively strong, and I've mentioned already China looking actually very weak at the moment, then India, Brazil and Mexico, chosen really just because the data is readily available on a timely basis. Really, again, as in China, demand in these economies still looks to be no more than at parity with pre-COVID levels, and in some cases lower. And our estimate for your own market in India is that possibly, given the latest round of lockdowns, a highly speculative estimate would put Indian oil consumption 1 million barrels a day down in April versus March. We shall see. But this all builds to a view that the demand recovery, which was quite impressive in the early months of the immediate post-lockdowns, if you like, in the third quarter of last year, if I remember rightly, in India, you lost most of the consumption in your domestic sales in April, but really within 3 months, I think sales were back to around 80% of where they had been pre-COVID. And that's a picture that's reflected across the globe, but really since then the pace of recovery has slowed, and it's been very muted. So the recovery is struggling to make much more headway. In Europe, we're still 2 million barrels a day below pre-COVID levels. The US is still 1.5 million lower. But nevertheless, floating storage is declining. And we use floating storage as a good indicator of marginal storage economics. It's the most expensive. So when the requirement for storage is most acute, then we see large spikes, as we did last year, across the product complex and indeed in crude oil. But generally speaking, gasoline is pretty much back to normal. Fuel oil is actually below normal if we just regard normal as being where we were before the COVID pandemic struck. The only real problem still remains in middle distillates, where jet fuel and gas oil, diesel, are still relatively elevated compared to pre-COVID levels. So I think my judgment, or my simple message, would be that the gasoline market looks as though it's, broadly speaking, corrected at a global level, but middle distillates is still a problem. And what's been key to this is, of course, refinery utilization. It's been very, very weak. I guess before the latest shocks in India, utilization had recovered to pretty close to pre-COVID levels, if not to the same level. It has recovered in China to a large extent, but in many parts of the world it still remains depressed. In Europe, we're still struggling even to get back to 70% utilization, which is extremely low. And even in the US, utilization looks healthier at around 80 to 85% at the CDU, but I mean, that is still a long way short and lower than where it was in more normal operating environments. And that is despite the fact that we have seen, as you're all aware, a very large spike in gasoline cracks in recent weeks and months. So there is clear evidence that the US refiner is being restrained, is being conservative, and so far is resisting chasing the gasoline margin because of the risk of overproducing middle distillates and adding to an inventory position which is still, if not within the US, then at least globally still a little on the long side. So helping the rebalancing process across the refining complex, we've had a very aggressive maintenance season this year so far. A lot of postponed maintenance from last year when COVID meant that operators couldn't do it. Clearly, with margins and cracks still very depressed, there's always an incentive for refiners to take the opportunity to do additional or advance some maintenance work. So maintenance has been supportive, but also increasingly is capacity closures. So we're now seeing about 3 million barrels a day of CDU capacity. Some of it's already closed, some of it an equal amount will close this year, and then there's a bit more in the next 2 to 3 years. And I'm sure that there will be further capacity closures announced as we go forward. And just to give you a slightly different perspective on the capacity closure situation, there are the same numbers expressed on a regional basis. It's very heavily Atlantic Basin orientated, as you would expect, but a fair amount in Southeast Asia, which of course is very heavily influenced by what's happened or is happening in Australasia, in Australia and New Zealand. So capacity is adjusting, refiners are keeping utilization broadly under control, and they have to, because they have to adjust down the current inventory position. And as we go forward over the next few years, they have to deal with, against a background of against a demand environment, which I'm suggesting could remain quite weak. They have to deal with a still very healthy pipeline of new projects coming to market. So if we have 3 million barrels a day of capacity to shut in the near term, that does not prevent global CDU capacity increasing by 2.6 on a net basis through 2024. Most of that is in Asia Pacific and the Middle East. And that is problematic if the demand environment is indeed going to be as weak as we anticipate it may be. Looking at feedstock costs, i.e. the price of crude. We are relatively bullish, if you like, about crude price. Not as bullish as many in the market. The Goldman Sachs of this world are once again relatively upbeat about the prospects, or the upward prospects for crude price. We think that the current price is slightly overinflated. I think there's a bit of a speculative bubble built up around the US economic recovery, and there are certainly expectations that the gasoline season in the US could be quite frothy this year, which would be another reason to be optimistic on price. But I personally feel it's a little overdone at this stage of the recovery. The rebalancing process is well in hand. If we start from the Q2 position of last year, when something a little over 1.2 to 1.3 billion barrels of crude and products went into storage somewhere in the system. Well, I think today we've probably run about 50% of that surplus down, so that's been absorbed. And even with our slightly pessimistic view of demand recovery going forward, the restraint by OPEC plus producers in keeping barrels off the market, the lack of any recovery in US crude production at the moment, and that's, I think, going to remain a feature for the next 12, possibly 18 months. I don't anticipate any recovery, meaningful recovery in US output. Nevertheless, as long as OPEC plus stick to their guns, then the rebalancing process will continue. We might consider the situation by the end of this year as being pretty much back to normal, i.e. the surplus has been absorbed, and that is, I think, generally price supportive. I don't think I would prefer it if the price were for North Sea dated Brent. I would prefer if the price was closer to $60 than $70 a barrel, because that would be, in my view, more in line with fundamentals. But we shall wait and see. But nevertheless, I think, broadly speaking, you should continue to anticipate good support to crude price, a very firm OPEC plus delivery of production restraint, and not really much price weakness until possibly in 22 and 23. One reason being Iran will return. I'm pretty sure of that. There are already barrels, certainly signs that Iranian exports to China have ticked up in recent months. Some of the independents in China seem less sensitive to the threat of US sanctions and are happy to import Iranian barrels, which have mysteriously vanished from the official trade data, but have been replaced by an increase in crude of unknown provenance, i.e. we don't know, strictly speaking, where these barrels have originated, but they are arriving in China, a source unknown, and it probably almost certainly is Iranian crude. And then next year, I think in the first half, there's a real possibility of a resolution to the sanctions situation, or at least a significant easing, in which case we must start to factor in possibly 2.5 million barrels a day of Iranian exports, and that's going to be bearish on price potentially. It will be a struggle for OPEC to accommodate those barrels. Another key issue to keep your eye on is whether or not the OPEC plus agreement gets renewed next May. I'm certain that the Russians are looking to exit as quickly as possible. I don't know if they will. I don't know if they'll sign up again. My assumption or my sneaking suspicion is that they will not. And therefore, as of May next year, the OPEC Plus arrangement will dissolve, and it will be left once again, as it historically has been, in the hands of OPEC itself to maintain market management and keep prices supported at acceptable levels. That means that they will have to reduce production. They, of course, being the Middle East, Gulf countries, Saudis and others, they will have to do so in order to A, keep the market balanced in overall global terms, but also B, accommodate the return of Iranian barrels. So my view of price is relatively more bearish in 22 and 23 than it is this year, although in the very near term I am still expecting prices to ease somewhat from the more recent $70 a barrel that Brent has been trading. Product cracks this year have staged something of a recovery. Perhaps if we look at the bottom chart first, because that's really where there has been evidence of a good recovery, led of course by gasoline. But diesel has been a little bit stronger. Jet fuel still remains very depressed. The naphtha price is looking relatively healthy, and fuel oil is still well supported. And it's kind of interesting in all three markets now to observe the red line, which is the 0.5% very low sulfur fuel oil bunker price, which is a premium product priced in excess of the road transport fuels in the current environment. Which of course sends a clear incentive to cat cracker operators to produce bunker fuel rather than gasoline, and there are consequences for VGO pricing and trade. But broadly speaking, the cold snap that we saw in the US back in the end of the first quarter, start of the second quarter, was very, very price supportive. Utilization in the US collapsed to 56%. It still hasn't returned completely to normal. The Texas refining system was just not built to operate at those temperatures, and they've suffered significantly as a consequence. And that really strengthened gasoline in the US Gulf. We've seen $20 cracks against North Sea dated here. I'm measuring simply using North Sea dated as the basis crude. That has to some extent fed into the Northwest European Rotterdam gasoline quotation, because clearly the arbitrage is direct. And more recently, it's begun to show up a little bit in Singapore as well. But in flat price terms, the US Gulf crack at 20 is double what it is in Singapore or Europe. Generally speaking, despite what demand recovery we can record, despite refinery utilization remaining firmly under control, really the experience to date is of no significant recovery in cracks, and they remain very depressed, and in most cases still generating negative refinery margins. But the situation will get better. It has to. The refining system cannot continue to operate at a loss. It's just not sustainable. Therefore, prices must go up and cracks must go up. We see, as I've already mentioned, the US recovering before other refining hubs, but generally speaking, across the course of this year, but particularly I think in 22 and 23, I do think cracks this year are going to remain under pressure until the inventory system has fully adjusted, and until demand really has picked up, which I think, and I sincerely hope it will do in the second half of this year, as the vaccine programs do make progress. But I think really a proper recovery in cracks must wait for 22 and 23, and even then I would be very surprised if we get back to the level of cracks that we've been used to in the last 5 to 6 years. So across the board, at least the distillate board, and across all regions, we peg our product cracks certainly above 2021 and 22, and 2020, but generally speaking below 14 and 8, well, the 14 to 19 average. Fuel oil, I'd like to just make a couple of comments around the fuel oil complex, because it is significant for the refining industry generally. As the refining system increases its complexity, so it is much more aligned to the price spread between light distillate transport products and the residue, the fuel oil price or the residue price, which of course is the feedstock for upgrading. And there has been a structural shift developing over a period of years now. The global crude slate at the margin has lightened significantly, and that is a direct result of the growth in US crude production, which of course is light sweet, little residue yield, and in order to keep the market in balance, OPEC producers led by Saudi, but more recently including Russia, this year, or last year rather, they've had to move over, give up market share, take barrels out of the market, and that means there has been this direct replacement of light sweet crude for medium and heavy sour crude, and the residue yield has tightened as a result. And of course this year, with an average cut of 8.5 million barrels a day across OPEC plus, all of which basically tends to fall on the medium and heavy grade residue rich crudes, the tightness has been really much more acute this year. You can see top right hand on this chart the change over the last 3 years in terms of crude trade. It's a direct reflection of the trends that I've just been mentioning in terms of production. The consequence for residue is illustrated bottom left, where, if you like, I hope I remember the number correctly, but something around 2.7 million barrels a day increase in crude runs has, broadly speaking, produced no incremental yield of residue at all, and that's in a refining system which is adding complexity and adding upgrading every year. So it's not a surprise then that the residue balance has been very tight, and we've seen the consequence of that in terms of high fuel oil cracks and very narrow light heavy crude differentials, to the point where the Dubai differential in 2020 was actually above Brent, which of course is something that really shouldn't happen. I think it's probably best. So if we look at our fuel oil cracks, and these of course will directly inform light heavy crude diffs, we do see, we certainly see the VLSFO, the 0.5% product, retaining its premium characteristic. We see low sulfur fuel oil prices equally strong because they represent a useful blend stock and for making VLSFO. But really the high sulfur fuel oil crack, whilst remaining negative, is significantly less negative, at least for the very foreseeable future, than it traditionally has been. And certainly if you go back further than the 2014 to 18 average, much more much better supported than it was back then. And it reflects the need for producers to continue to maintain market management. My main concern here and uncertainty is whether or not high sulfur fuel oil will actually remain even better supported than we're showing here for post 22. That will be a period when we can expect US production to start growing again. That will mean further pressure on Middle East producers to cede market share, and possibly Russia as well. And if we're being overly conservative about the pace of that growth, and we are relatively conservative, we don't think it's going to go back to the situation that we saw in the last 5 years or so, then there could be even further pressure on the crude slate in terms of a lightening, and the residue balance as a result would be even tighter than we expect. And just to end with a few high-level observations about the approaching energy transition. It is coming. It will affect you in India sooner or later. Your government will decide how quickly it wants India to conform to these to the call for climate action. But this is sometimes this is quite an interesting chart, I think, because it just illustrates how wide an initiative to achieve net zero CO2 or GHG emissions here by 2050, just how widely this this aspiration, I don't think it's anything more than an aspiration at the moment, but how widely it is being signed up to by countries. I mean, some countries have enacted, others are in the process of enacting, others are much not as far down the road. They're talking about it, and it may just be pure talk. But it is illustrative of the direction in which we're headed. Of course, coming up with these sort of mandates and aspirations, that's the easy bit. It's actually enacting hard policy initiatives to achieve them that's the difficult bit. And there's a large amount of uncertainty about whether or not we get there and how soon we get there and who gets there. But this is a one-way road. We're not going to backtrack on it. In Europe, we are now electrifying our vehicle fleet very aggressively. There are very good reasons for it, which I will show you in just 2 or 3 minutes. But there are, again, it's very heavily Eurocentric, but it's not entirely. There are countries in Asia and elsewhere who also have clearly stated that they will ban the sale of petrol and diesel vehicles, pure petrol and diesel or gasoline and diesel vehicles by a certain date. It's still a long way off in the future. At the moment, the proportion of vehicle sales on an annual basis accounted for by pure electric vehicles, these are non-hybrid, these are plug-in electric battery vehicles, is relatively small still. But again, we're at the start of this one-way street, and it will just continue to accelerate. And we do, as a result, have a very clear view now, I think, of where peak demand globally may take place. Compared to our forecasts of a couple of years ago, I think the level and the timing the level has come down. I don't think we're going to get up to the 110 million barrels a day of global demand we expected as recently as 2 years ago. I think it's going to be closer to 100. The timing looks very much the same, but it does mean that peak demand is a very real risk confronting the refining sector globally. In the interest of time, I'll leave you to peruse some of these charts on your own, but these represent our assumptions, because they are pure assumptions about how quickly electric vehicles penetrate global fleets. Europe will overtake China, we think, as the largest EV market before too long. There are very strong drivers now to the electrification process. Battery prices are now very competitive. Most commentators and experts now believe that not only will pure electric vehicles be price competitive at the point of purchase for consumers within the next 5 years, but actually will be cheaper to produce and to sell, and that the price in the sales room for a pure EV will be lower than that for diesel and gasoline in the foreseeable future. And then in Europe, we have very aggressive vehicle CO2 emission targets, and producers will be very heavily penalised financially if they miss these targets. These are average fleet-based targets, and the only way they can meet them is by convincing consumers to buy electric vehicles. And then, of course, the other issue which the refining sector has to deal with in terms of the energy transition is the increasing penetration of biocomponents into the finished transport fuel. At the moment, on the basis of first generation technologies, where the biocomponent competes directly with food production and food availability, or directly impacts land use and deforestation, then there are pretty firm and strict and low caps to the amount that can be added. But that's changing rapidly as second generation technologies take advance, and the proportion of biocomponent in diesel and mainly diesel could be as high as 50% by before too long. I'm not sure we actually have a specific target date in mind for that 50%, but in theory, these are technologies which would not impact food production and land use, and could be made available to a significant extent, such that it would materially reduce the demand for refinery sourced product. And the oil companies, the larger oil companies, global integrated majors, are quite clearly sitting up now and taking notice. ExxonMobil, even Exxon, reduce its greenhouse gas emissions over the next 5 years. BP has serious ambitions for net zero by 2050. Shell is selling a lot of its refinery assets under pressure from investors who say, we don't want you to be so focused on fossil fuels because there's no future for fossil fuels. We want you to become delivering green energy, environmentally sensitive and acceptable energy. And all oil majors' credit ratings now are under serious threat from growing climate risks. This, if anything else, is a sign that this process can only accelerate and go one way in the future, because once the investment community starts telling the boards of these companies that this is where their future lies, really the boards have no option but to comply and to follow. So I'll leave it there. Thank you. I hope you've stayed with me. If so, thank you.
So moving forward, I think Vlasios will be presenting on Argus possibility curves. Vlasios, over to you.
Hi everyone. Thanks, Parimal. So I'm gonna start doing the classic step, which is to share my screen. Can you let me know whether you can see the screen?
Yeah, it's visible.
Okay, great. So today I'm going to give you an overview of a new product that we have developed at Argus. So about 3 years ago, Argus developed new capabilities by bringing effectively a data science team. And the idea of the data science team is to create products that can be used for trading and hedging. So the first product we develop is around the possibility curves, and currently we cover crude, and from the summer we'll also cover refined products. So the plan for today is to give you a kind of an overview of what it is the possibility curves, what they look like, how they can be used. And then towards the end, I have a case study that we have done with a client. It's actually a government organization where they use the possibility curves to time their sell of some assets. So what is the possibility curves? The possibility curve effectively merges machine learning technology, data science, and some of the unique Argus datasets in order to create signals that the clients can use for hedging and trading. What actually they do is they provide a prediction for the price of oil and the probability to observe that price. So the idea here is that the possibility curves will not tell you what will be the price of oil next month or the next 3 months, but it's going to give an indication of a range of prices with the different probabilities that we can observe these prices. So how we do that? So we start initially by creating what we call the Argus universe. So the Argus universe is a database that we maintain on a daily basis that effectively includes data from the market, like things like the stock levels, the performance of the financial markets, bond yields, interest rates, and also some of the unique Argus datasets. And that includes like the volume of crude or the volume of refined products, and also the assessments that we are making around the world. These two datasets go through a process that we call feature engineering in order to prepare the dataset to help us forecast better the price of crude and refined products. We also developed a machine learning framework that has been customized to work specifically for the oil market. So this is not an off-the-shelf data science process, but it is something that we have developed within Argus by integrating our knowledge of how the market works. The output of these two is effectively the possibility curve and the key drivers that are affecting the markets today. So the idea here is that to give someone an indication of the prices and the different probabilities and whether the likelihood of the price to be on the higher level or the lower level of that curve, but also what are the key drivers that help us shape that curve. And we classify the drivers into 3 areas. That's the Argus prices. That is the impact that comes from the physical prices. We have the financial drivers, and here include things like the positioning of the money managers, the circulation of money in the economies, interest rates, bond yields, and also the fundamental drivers, some of the drivers that Francis was speaking about, which is, for example, stock levels. As part of the overall offering, we also offer the forward curves and the outlooks that Francis was talking about. So the idea of the possibility curve is effectively to give an idea of the degree of the uncertainty that we are expecting in the market over the next 3 months. But more importantly is to estimate the upside risk versus the downside risk. And if you then overlay into these intervals the forward curves or an outlook, then effectively will give you an idea whether the commodity might be underpriced or overpriced. The example you see here is a forward curve that effectively suggests over the next 3 months, the commodity is mispriced, and in the sense that we are expecting a recovery in the price of the commodity. So the possibility curve is a kind of a signpost. So it gives the upside, downside risk, and degree of uncertainty. And then when you have a price from another service, you can effectively see if there is an opportunity for hedging or trading. In order to save this possibility curve, so it doesn't look like as a black box that comes out of a data science process, we are also disclosing what are the key drivers. So what you see here is on the left side, that's the key drivers that were affecting the Brent. And the top driver is actually the total volume of crude that Argus is recording globally. So this is not the volume from the futures contracts, but this is the physical volumes from crude that are moving around globally. So when we try to shape the lower side of the possibility curve for that particular month, the Argus physical price actually was the top driver, and it was almost accounting for 28% of the forecast. The second most important driver was actually from the fundamental space, which was the US stock distillates of fuel oil that accounts for about 27% of the total forecast. And the fourth driver is actually the daily volume of the futures contract. And that's the impact comes from the financial space, which accounts for about 9% of the total forecast. When you look at the upper side for the upside risk on the prices, the top driver actually became the US distillates of fuel oil that was accounting almost for 30% of the forecast. And the second and the third driver are actually coming from the financial space. So the whole idea of showing you the different drivers that are affecting the curve is that these drivers can be used as a signpost when something significant is happening in the market, so that you can actually try to focus of what are the things that I should be monitoring on a daily basis to understand what's happening with the price of oil or the price of refined products. That drivers and their importance is actually updated every week, and they always look up to 3 months ahead. So what's happened every Monday, we're actually producing the new possibility curves with the new drivers that gives an idea of what's happening or what might happen in the crude market and the refined products market for the next 3 months. This is an example of the most important drivers for the refined product. Effectively, this is the ICE gas oil. And what we are looking at here is that what were the 5 most important drivers that are effectively affecting the dynamics of the ICE gas oil. And what we see here is that the volatility index, it was an important driver, as you might expect when the market is going into the volatility regime. We expect effectively the crude oil volatility index to be actually an important driver. But then, interesting enough, there are 2 prices here that are actually the Argus assessment. So although here is the ICE gas oil, we see that there is an impact that comes out of the Colonial Pipeline that was an important driver that was affecting the dynamics of the prices, and also the gas oil, that is the assessment that we are making in Germany. Outside of the oil area, what we see is that the 10-year bond yield from Germany was an important driver for the prices of the gas oil, and also a subsector of the Dow Jones, which was basically the oil exploration and production companies. So what this one is tracking effectively the performance of the stock prices for these companies. So what we see here is when we try to understand the uncertainty and the volatility in the market, it's not just the physical space that is important. You have to have effectively information from the financial market, the bond yields market, and also what's happening in specific assessments in that particular instance from Germany and the US. The reason why you see these graphics that are a kind of a U-shape, what basically this is telling us that if we take the example of our assessment we make in Germany for gas oil, we will see here that this is by far the most important driver are the tails of that curve. And what this means is that if we are expecting a market moving event, then the price that we will be tracking in order to understand the impact on the ICE gas oil will be our assessments in Germany. But if we don't expect a market moving event and we think that the market is going to move into a sensible range, then the most important driver is actually the assessment that we are making for diesel in the Colonial Pipeline. As part of the service, we are also publishing a daily report. So that daily report aims to give our clients the key drivers that are affecting the market for tomorrow. So the report usually is published about 7 o'clock London time, and it basically gives the list of what are the key drivers someone should be observing for the next day and the weighting of these drivers. And we provide that service for Brent and WTI. At the same time, we also provide a very short commentary. So we try basically to explain what are the key drivers for the volatility for Brent and what are the key drivers for the volatility for WTI. So that particular report is really only 2 pages. The first page is made up of the drivers and the weighting and a very short commentary, and the second page is actually to have some graphics that can help understand the overall trend in the market for these 2 commodities. We also have an interactive dashboard. So what this means is that someone can go actually to the dashboard and do a further investigation and try to look at the data or what's happened over the last 5 years. And I will show you an example later in the presentation how we use the dashboard and the historical performance to understand what's happening when the COVID will start impacting the demand for refined products. This is how the dashboard looks like. So effectively, all the data is available through the Argus Direct, and here someone can come and select the curves that they may be interested. That is can be crude for the monthly curves, the weekly curves, or the daily curves. These are the different grays that we currently cover, and the horizons is up to how many months into the future. So as part of the data science service, we only provide the view over the next 3 months. The difference is that this is a rolling 3 months. So in other words, like every Monday we add an extra week into the forecast. This is what we forecast at the beginning of the month for Brent and WTI. And you can see that at the moment, the prices, they are actually oscillating within our 50% interval with respect to what we were forecasting. So the idea of these intervals is to show you what will be the average price of the month. So there's a 50% chance, for example, we are expecting the average price for WTI to move within this dark blue area. If I now switch into the dashboard very quickly, so that is the dashboard. That's what we publish for the next 3 months for WTI, and that effectively covers the delivery for July, August, and September. So overall, what we are expecting is similar to what Francis was saying with respect to the outlook. We see a much higher, from where is the price currently, we see a much higher downside risk that is going to build up in the market over the summer period for Brent. There is a bit of a likelihood that the price might stay a bit stable around the price that are today, like between $65 and $70 per barrel. But all we say is that we do expect a higher downside risk versus to what is the price right now. That might be useful if someone wants to start doing a kind of a hedging program. So if I go back to the presentation, then I'm going to use that information in terms of hedging of how one of our clients actually used the possibility curves the last 3 months for some of the decisions they have to make with respect to crude. So just as a reminder, at the end of 2019, we knew that something was happening in China, but we didn't know exactly the cause for that. On the 13th of January 2020, we have the first case of a novel coronavirus outside of China that has been confirmed. And then beginning of February, we basically have some of the announcements that comes from the WTO. And then only on the 4th of March, the WTO basically say that this is an unprecedented situation. So the next slide, I will now show you what did we forecast is going to happen at the beginning of January. So back then, that information here was not known. So we only basically knew the information that was at the first bullet point, that there is a problem that has been reported in China, but we didn't really have a very good understanding of what that meant. So at the beginning of January 2020, we published the possibility curves, and the example you see here is for March. And what basically we said back then is that we are expecting a significant downside risk. And the price of oil, when we published, was as almost $62 per barrel for March. And effectively, we were saying that it will not be unthinkable if we see the price to drop even closer to $50 per barrel. So that was almost expecting a $12 drop. And that happens really at the very beginning of January. As we will keep publishing the curves and we move from January to April, it was basically quite clear to us that not only this downside risk was maintained, but actually it was starts increasing. So what we were suggesting is that by April 2020, we will not be surprised if the price of oil for March was dropping to as low as $14. So effectively, the possibility curves were used to start monitoring the situation with respect to the risk. So it's not the idea here what will have been the exact price from us, but it was to try to see the price was dropping from $62 to $22. Is this the end of the drop? And we were basically suggesting no, there was actually likelihood that the price will actually keep dropping even below $20 per barrel, which actually has happened. This is how we monitor the situation on a month-by-month basis. That starts from January and all the way to April. And as you can see that in all the cases, the curves they were shifting to the left. So basically they were always suggesting higher downside risk, and the whole center of the curve was suggesting that downside risk actually was increasing. And then we have the big, effectively, expectation for a major shift that happens between March and April. So what were the key drivers? So how did the possibility curves, they were trying to understand that negative balance of risk. And there are a couple of things here. So the crack spreads, if you look all these months, the crack spreads was actually one of the most important drivers that they were suggesting to us that something is happening on the demand side of the industry, and that was causing the very high negative balance of risk that we were expecting in the price. We also noticed that the refined products, the assessment that we make on the refined products was actually a very important driver. Also the crude, the volume of crude that is actually being supplied to the market. So what we see here is a kind of a pattern that was suggesting crack spreads, refined products, and the actual crude volume was actually the most important drivers for us to estimate that something is happening in the market. There seems to be a dislocation, and that estimation was happening since the beginning of January 2020. So our overall drivers that we basically gave to the client recently, that was about 3 weeks ago, these are the key drivers that someone should be monitoring if we think there is another wave of COVID that is coming after summer. And the reason why we use the possibility case for that is that we don't claim that exactly the same impact that will happen in 2021 as it happens at the beginning of 2020. But what we say is that these are the drivers that are likely to set the rhythm if there is another big wave of COVID that's happening globally. And these drivers effectively, what they are primarily trying to capture is what's happening on the refined products, the crack spreads, but also to look into the exchange rates, because that will be a proxy about how the economies will start reacting to that event. And that is what one of our clients currently is monitoring as they try to make the second level of decisions with respect to the crude towards the end of the summer, beginning of September, October. So that's what I want to show you for today. And if you have any questions, I'm more than happy to answer.
Nonetheless, we are always available on email or call. So please do feel free to reach out to us. And we'll be uploading the slides to Indian Service Portal, Indian Oil Service Portal. And emails will give you the link to do that. So thank you everyone for joining.
Thank you very much, Parimal. Thank you very much, Francis and Vlasios.
Very, very, very welcome. Good
Thank you very much.
Be with you today. Thank you.
Yeah.
Bye-bye now.
Thank you, everyone.
Thank you.